What if everything you've been told about economic weakness is backwards? While headlines warn of slowdowns and politicians debate recessions, Morgan Stanley just raised its S&P 500 target to 7,800 by the end of 2026, a 16% surge from current levels. Not a hope, not speculation. A calculated bet that contradicts nearly everything the financial media wants you to believe. But here's the question that will drive this entire story. If one of Wall Street's most influential banks sees a massive rally coming, while most investors remain cautious, what do they know that you don't? The answer isn't hidden in quarterly reports or economic forecasts. It's buried in a pattern that's played out across every major market cycle for decades. A pattern that separates those who build wealth from those who watch it pass them by. This isn't about stock tips. It's about understanding how markets actually move, and why the greatest opportunities always appear when everyone else is looking the wrong way. Welcome to the Wealth Timeline, where we uncover how money, power, and history are woven together to shape the world we live in. Today, we're decoding one of the most aggressive bull calls on Wall Street and revealing the two structural forces that Morgan Stanley believes will drive markets higher even as uncertainty looms large. Let's start with a truth that makes most investors uncomfortable. Markets don't reward caution. They reward those who can see inflection points before they become obvious. Right now, Michael Wilson, Morgan Stanley's chief U.S. equity strategist, has issued one of the most bullish forecasts tracked by major financial data providers. His team projects S&P 500 earnings per share of $272 in 2025, $317s in 2026, and $356 in 2027. That's not a gentle climb. That's a 17% earnings surge in 2026 alone. But here's what makes this forecast remarkable. It comes after the S&P 500 has already delivered returns exceeding 25% for 2 consecutive years. Most strategists are calling for muted gains. Many are warning about overvaluation. Yet Morgan Stanley is doubling down. Why? Because they're not looking at what the market has done. They're looking at what's about to happen beneath the surface, in corporate cost structures, in Federal Reserve policy, in sectors that have been left for dead. And to understand why they're so confident, we need to go back to a moment when similar conditions created one of the most powerful and misunderstood market recoveries in modern history. October 19th, 1987, Black Monday. The Dow Jones Industrial Average plunged 508 points, 22.6% in a single day. It remains the largest single-day percentage loss in stock market history. $500 billion in capital evaporated. Panic swept trading floors. Investors fled. The media declared the bull market dead. But something unexpected happened. Alan Greenspan, just 2 months into his role as Fed chairman, released an unprecedented statement. The Federal Reserve affirmed its readiness to serve as a source of liquidity to support the economic and financial system. The Fed slashed interest rates by 50 basis points and injected billions into the system through Treasury buybacks, a practice that would later be called quantitative easing. And here's the critical insight most people missed. The havoc in financial markets did not spread to the broader economy. GDP continued to grow through 1987, 1988, and 1989. The fundamentals were intact. What had broken wasn't the economy, it was confidence. Within 20 months, the market had fully recovered and went on to achieve new highs. Those who sold in panic locked in permanent losses. Those who understood the disconnect between market sentiment and economic reality, who saw that corporate earnings hadn't collapsed, positioned themselves for generational gains. This is the origin of a pattern that repeats: fear creates the greatest opportunities, but only for those who understand what's actually breaking and what's still intact. And right now, Morgan Stanley is identifying a similar moment. A point where perception and reality have diverged so dramatically that the next move will leave most investors behind. Let's talk about the first reason Morgan Stanley is so bullish: the rolling recovery in corporate earnings. For 3 years, from 2022 through early 2025, the U.S. economy has been in what Morgan Stanley strategists call a rolling recession, a drawn-out downturn that escaped headline GDP but left deep marks in business hiring, earnings, and confidence. Earnings growth was negative for most companies over that 3-year period. Different sectors hit recessions at different times. Tech companies faced a payback from COVID demand. Industrials struggled with supply chains. Small businesses cut to the bone. But Wilson argues that April 2025 marked an inflection point, what he calls Liberation Day, when President Trump's tariff policies created maximum bearishness. And it was precisely at that moment of peak pessimism that earnings revisions began a V-shaped recovery. The evidence? In the third quarter of 2025, median companies in the Russell 3000 index reached 11% EPS growth, almost double their second quarter rate of 6%. Of S&P 500 companies reporting third quarter results, 82% beat earnings estimates and 76% beat revenue estimates. But here's what's really driving this. Cost structures have become significantly leaner as companies right-sized during the downturn. Wage expenses have come down dramatically. Companies cut deep during uncertainty. Now, even modest firming in top-line revenue and pricing power creates disproportionate bottom-line leverage. This is textbook early cycle dynamics, compressed costs, pent-up demand, a historic rebound in earnings revisions breadth. And it's happening across the entire market, not just in big tech. Profits are expanding across many sectors beyond big tech, supporting Wilson's thesis that the stock market is in a rolling earnings recovery. But earnings alone don't drive 16% rallies. There's a second force at play, one that amplifies everything else. The second catalyst, an accommodative Federal Reserve willing to run it hot on inflation. Here's where Morgan Stanley's thesis gets controversial. The Federal Reserve cut rates 3 times in 2024, by 50 basis points in September, then 25 basis points in both November and December, bringing the federal funds rate to 4.25% to 4.50%. In 2025, the Fed delivered additional cuts, bringing rates down to between 3.75% and 4.0%. Most analysts expected the Fed to pause. Inflation remained above target. The Fed projected just 2 additional rate cuts for 2025, down from the 4 it had forecast earlier. But Morgan Stanley's analysis suggests something different. Policymakers in the U.S. appear content to run it hot when it comes to inflation, pointing to efforts to deal with higher debt levels and deficit spending. Why does this matter? Because when inflation is accelerating, that's a sign that pricing power is strong, and broader earnings growth follows. The best year for earnings, not just for small caps, but for the equal-weighted S&P 500, was 2021, when inflation was rising. Morgan Stanley isn't betting on runaway inflation, they're betting on moderate inflation, 2.5% to 3%, combined with rate cuts. Wilson expects an accommodative Federal Reserve, with continued rate cuts and a supportive balance sheet stance. This creates a perfect environment. Companies can raise prices, supporting revenues. Costs remain controlled, protecting margins, and borrowing costs decline, encouraging investment and M&A. Over the next 6 to 12 months, moderate weakness in lagging labor data and a stronger-than-expected earnings backdrop should set the stage for a broadening in market leadership. This is the rise. The moment when 2 powerful forces, earnings leverage and monetary accommodation, combine to create conditions that feel uncertain in real time, but look obvious in hindsight. But every rise contains risks, and understanding those risks is what separates informed positioning from blind optimism. So what could go wrong? Wilson acknowledges his optimistic outlook isn't without risks. Near-term challenges could emerge if the Federal Reserve maintains a more aggressive policy stance than markets currently anticipate. If inflation surprises to the upside, not moderately, but dramatically, the Fed could be forced to reverse course. Higher rates would pressure valuations, growth would slow, the rolling recovery could stall. An overheating economy presents another potential obstacle. If growth accelerates too rapidly, it could reignite inflationary pressures that force the central bank to reverse course on rate cuts. There's also valuation risk. The S&P 500 is currently trading at 23 times forward earnings, far above its historical average of 16 to 17. Morgan Stanley forecasts a 5% contraction in valuation multiples, which will likely cap equity market gains despite improving corporate earnings. And then there's the psychological breaking point, the gap between knowing a rally is possible and surviving the volatility required to capture it. Markets don't move in straight lines. They test conviction. They create false breakdowns that look like the end right before the real rally begins. This is where most investors fail. They understand the logic. They see the opportunity. But when the market pulls back 5%, then 8%, they panic. They sell. They convince themselves the thesis was wrong, and then, weeks later, the rally continues without them. Morgan Stanley's forecast assumes you can endure the turbulence, that you won't be shaken out during the inevitable corrections, that you have the discipline to stay positioned when your instincts scream to exit. Because theory without execution is useless, and execution requires structure. Let's talk about what happens when you don't have a disciplined strategy. In March 2020, when the S&P 500 crashed 34% in weeks during the pandemic, retail investors panicked and sold. Institutions bought aggressively. By the end of 2021, the S&P had gained 75% from the lows. Who made money? Not the majority. The same pattern played out in 2009. In 2002, in 1987. The fallout is always the same. The masses lose wealth during volatility. Institutions consolidate it. This isn't conspiracy. It's structural. It's the natural result of having better information, better tools, and, most critically, better discipline. But here's the empowering truth. You don't need to be an institution to think like one. You just need to follow the same principles they use. And that's what the 6 investing tips we're about to cover will give you. A framework for positioning on the right side of this wealth cycle. So let's bring this into actionable strategy. Morgan Stanley's 16% upside call is driven by a rolling recovery thesis, where earnings growth broadens across sectors, supported by leaner cost structures, firmer pricing power, and an accommodative Fed. Here are 6 investing tips to capitalize on this forecast. Tip number 1. Dollar cost average into positions. If the S&P 500 is going to rise 16%, it won't do so in a straight line. Layer into positions gradually over weeks, not days. Buy in tranches, 25% now, 25% on pullbacks. This removes the pressure of timing the bottom perfectly and smooths out volatility. Tip number 2. Upgrade small caps to overweight. Morgan Stanley upgraded small caps to overweight from underweight, citing compressed cost structures that set the stage for positive operating leverage, pent-up demand, historic rebound in EPS revisions breadth, and a Fed cutting rates. Small caps tend to outperform in early cycle environments. Allocate 15 to 20% exposure. Tip number 3. Overweight cyclical sectors. Morgan Stanley upgraded consumer discretionary goods to overweight from underweight. Remains overweight on industrials, citing strong top-line growth and positive operating leverage, and upgraded healthcare to overweight as the preferred exposure to quality growth, benefiting from rate cuts, supportive earnings momentum, and M&A tailwinds. Rotate into cyclicals, financials, industrials, consumer discretionary, which benefit from broadening economic strength. Tip number 4. Don't abandon tech. Stay selective. The Magnificent 7 mega-cap tech stocks that have dominated the index in recent years likely face a material slowdown in year-over-year profit margin growth. Don't abandon tech, but be selective. Focus on companies with durable AI-driven earnings growth and pricing power, not speculative plays. Tips number 5. Hold cash for tactical deployment. Even in a bullish scenario, corrections will occur. Holding 10-15% in cash gives you dry powder to deploy during dips. Cash isn't dead weight, it's optionality. It also prevents panic selling during volatility. Tip number 6. Rebalance. Quarterly, not daily. The biggest mistake retail investors make is overtrading. They react to noise. Institutions ignore noise. Set a quarterly rebalancing schedule and stick to it. Review positions every 90 days, not every 90 minutes. These 6 principles won't eliminate risk, but they'll position you to profit from the same forces Morgan Stanley is banking on, while protecting you from the volatility that destroys undisciplined portfolios. So here's what we've uncovered. First, Morgan Stanley sees a 16% surge in the S&P 500, driven by two powerful catalysts: a rolling recovery in corporate earnings as companies emerge from a 3-year rolling recession with compressed costs and improving pricing power, and an accommodative Federal Reserve willing to cut rates while tolerating moderate inflation. These aren't speculative bets. They're structural inflection points with historical precedent. Second, the real money isn't made by predicting the future. It's made by positioning correctly for what's already in motion. The smart money isn't smarter because they know more. They're smarter because they have the discipline to act on what they know, even when it's uncomfortable. Third, you don't need access to Morgan Stanley's research desk to profit from this cycle. You just need to follow the same principles institutions use: dollar cost averaging, overweighting early cycle sectors, staying selective in tech, holding cash for volatility, and rebalancing with discipline. But here's the final truth. Wealth isn't built by avoiding cycles. It's built by understanding where you are in the cycle and having the courage to act accordingly. Right now, we're at an inflection point. Morgan Stanley believes a new bull market began in April 2025, marking the transition from rolling recession to rolling recovery. The kind of moment that creates generational wealth for those who recognize it, and regret for those who wait until it's obvious. Because in the world of wealth and power, history never ends. It just changes hands. If you enjoyed uncovering this hidden layer of market mechanics, don't forget to like this video, subscribe to the Wealth Timeline, and turn on the bell icon. Because the next story might just rewrite what you thought you knew about power. Until then, stay curious, stay disciplined, and remember, the best time to act is always before everyone else realizes it's time.